Hi, this is Sean Hyman from mywealth.com, and I just want to go over today's blog, which is really kind of rehashing some previous blog posts that we have, just bringing you up to speed again on previous themes that have unfolded. Calling the breakout on gold and how I did it. Let's talk about that for a minute, because a lot of people think that you can't foresee or predict things that are going to happen. Now, the exact timing of them is tough, but lining up fundamental events and seeing the outcomes that come out of them really are not that difficult. So let's go through some of the reasons why I saw this coming. Back on January 2nd, I wrote an article in my blog at mywealth.com/blog about a bubble forming in the bond market. Money had run to bonds for safety. The appeared safety of bonds, and so much money had shifted from stocks and commodities into the bond market, it caused a bubble. And so I wrote that that bubble would burst pretty soon, and that money would go elsewhere, and the savvy investor has to ask himself, where is that money going to go? Well, gold had held up relatively well relative to the rest of the market, and it's also perceived as a safe place to go in tough times. And so that's why I titled the article From Bonds to Gold, because that's where I believe a lot of the money was going to go. And sure enough, that's what's happened. At the time of my second article writing, which was a two-parter, on the 22nd, 23rd, that you can also review on our blog, gold was at $8.53 an ounce, and yesterday it hit about $100 above that price then. Now, how did that come about? Well, firstly, we talked about the bond bubble forming, and so money needing to shift somewhere else. So that was one factor. Two, the money supply had just exploded. I mean, it was going across, and then it just went parabolic. So that's another factor. Anytime you've got the huge printing of money, it will have an eventual effect of dilution of the dollar and rising of gold. However, that one still is a delayed effect that's yet to kick in and even benefit gold further. There's fear in the markets. There's been a bear market in stocks. We've had a recession and talk of depression on the news. All that is a friend to gold. It helps the gold out, because money runs to gold when there's fearful times and negative talk on the news. Gold's strong relative to other commodities and also the dollar. So you can look at things like the CRB index, oil, other commodities, and see how depressed and how sold off they've gotten. Yet gold, relatively speaking, held up well in proportion to seeing how they outperformed against all these other commodities. The dollar was on a tear this year. It shot to the moon, yet gold didn't plummet as hard like the other commodities did, because a lot of times the dollar and commodities are kind of like on a seesaw, and the dollar's on one side and the rest of the commodities are on another, since they're priced in dollars. And so when the dollar goes up, it tends to push all these commodities down, and when the dollar gets devalued, it tends to help boost these commodities up. It's not the only factor that affects them, but it's one significant one. Well, there are short periods of time where the dollar and gold can go up together. Now, this huge printing of money is going to cause an eventual fall of the dollar, and once it does, it's going to boost gold even further. So there's going to be even a second round wave of effects that's going to help gold from the devaluation of the dollar that will kick in, and also the increase of the money supply that will finally be unclogged from the banks and released into the public. Also, there's been a lot of government delays with stimuluses, just all kinds of delays, uncertainties, lack of leadership. Also, a new changing of leadership with a new president. And a lot of people say, well, that's a good thing. Maybe it is, maybe it isn't. But the market always perceives change as uncertain and not liking the change, so that helps gold out. Global slowdown is eroding most assets. So, I mean, you've got most assets out there going down. In the last year, pretty much the only things that went up were the dollar, U.S. bonds, things like that, and the yen. So you've got very few assets that went up at a time. Most things went down. So you had erosion of assets. So money was running to places to hide, and gold is one of those places where it can go to park and hide. The South African mines, the gold mines, were just the icing on the cake for me. Their production, because of electricity problems that they had not tended to, had caught up with them, and the gold mine production there was down 14%. Now, it has not been that, they haven't had that drastic of a slowdown since the 1800s. So this is huge, because they're one of the biggest gold miners and exporters in the world. And so that was just icing on the cake there. And then you've got U.S. interest rates near zero. Along with the increase increase in the money supply eventually will cheapen money, devalue the dollar, and you'll eventually see the dollar plummet once again. When that does happen, there's your next wave for the gold breakout. But in the meantime, there's enough for gold to sink its teeth into for a first wave to unfold even still. So what do savvy investors do? They get positioned like a surfer looking for their wave. They go out there and swim out ahead of time because they see a wave coming. And savvy investors saw a fundamental truth, all these fundamental truths stacking up. And they saw this wave out in the distance coming. So what they do, they swam out there and turned around and got ready for it. So it's hard to time, just like the surfer, it's hard to time the exact time the wave is going to hit when you see it far off. But the closer it gets, the easier it gets to call. And so an investor, a savvy investor, does this as well. They go out there, swim, and turn around and get ready for the wave, and they keep watching for it to come. And as it gets closer, they get prepared. So how can you get prepared for this breakout that's occurred and what's still to come? The investor, let me talk to you for just a minute. The investor, you can go into GLD, that ETF, through your stock brokerage account. I would not suggest going into the commodity itself because you've got margin, you've got contracts that can expire, things of this sort. I really would encourage investors to stick with cash, stick with ETFs, symbol GLD through your stock trading account. You can do that through your IRA accounts or your taxable accounts. And then talk to the trader for a moment. There's a double long ETF symbol DGP, and this is all on the blog side. This is something that could be good for the trader. Now again, remember that this is a lot more risk, a lot more volatile. Of course, this is the trader's friend, is the volatility, and can get really directional really quick. So that's what a trader wants. However, do realize that's probably not the best situation for most people. A lot of people want to be the trader. They should be the investor. So I would highly recommend the investor side of GLD. But there will be some who want to trade this thing, and for the trader, it should be the DGP. There are other gold ETFs out there, but this GLD happens to have more volume, so the spreads are narrower, your fills are probably going to be a lot better, and so that's really how you probably be best positioned in this move. So again, check this out. This is just informational. It's not a recommendation, but if you do your own research and you come to these same conclusions, then these are some areas that you can get involved in. Check us out at mywealth.com/blog for the previous articles, the charts, because I give a chart of where we were at the 853 level and a chart of where we're at now so that you can go back and check this stuff out. Thanks so much for attending. Bye-bye.